Ever considered profit making when stock values decline rather than rise? Sounds too perfect to be real. Stay around though. In the following few minutes, we will walk you precisely through how short selling works and how you may be profitably turning the dip in the market into advantage. Imagine yourself selling it for cash, then purchasing it back later when it's less expensive. Let's dissect it so simple that even your old grandmother could do it. How short selling works. Short selling seems to be something only seasoned traders do. Though it sounds difficult and dangerous, the reality is that it might be easier than you would believe, and it might even help you profit when equities fall. Short selling could be the solution if you have ever questioned how individuals benefit in a market slump. Stay around, since in this video we will walk over it methodically and demonstrate how it works. Imagine this. You borrow something from someone, sell it for cash, and then later on when it's less expensive, purchase it back. What sounds unusual, the fundamental concept underlying short selling is really this. It's a means of profit when others are suffering loss. Let us explore the specifics of short selling operations, risk factors, and how to choose the best prospects. Short selling is fundamentally a trading tactic used by investors to make money from a stock's price falling. Traditionally, when you acquire stock expecting the price to climb, so you may profitably sell it later. With short selling, however, the objective is just the reverse. You're expecting the price of the stock will decline. Though that seems paradoxical, short selling has beauty. An investor borrows the shares of a stock, sells them at the current market price, and then subsequently buys them back at a reduced price, therefore repaying the borrowed shares to the lender. Profit is what separates the buying from the selling prices. It's like visiting a pawn store, borrowing a necklace for $100, selling it for $100, then a week later purchasing the identical necklace back for $80 to re-offer to the pawn shop. Your profit is the $20 variance. Straightforward. The drawback is that the stock price doesn't always drop. When it rises, you can find yourself in hot water. Further on that in a moment. Short selling's procedure. Short selling starts with someone else borrowing stock from you. Usually, a broker handles this on behalf of investors wishing to sell their stocks short. Usually housed in a margin account, these investors hold the shares. You merely borrow the shares, you do not own them. You are merely borrowing them with intention for a return later. Sales of the shares follow your borrowing of them. Here's the area where you were expecting the stock price would decline. Suppose you borrow 100 shares of a corporation and sell them for $50 apiece. Selling those borrowed shares has you with $5,000 in cash. Assume then that a week later the stock price falls to $40 per share. For about $4,000, you may now purchase back the 100 shares. The difference, $1,000, becomes your profit when you give the lender the returned shares. The hazards of short selling. Short selling is one of the largest risks since the stock price can rise rather than fall. Your losses may soon mount up rapidly when this occurs. When you short sell, you must purchase the stock back at a higher price in order to reimburse the lender, therefore losing not only the price you paid to borrow it. Returning to our case, if the stock price climbs to $60 rather than declines, you would have to purchase back off the shares at that higher price. In this instant, you would have to pay $6,000 to purchase back the 100 shares, therefore losing $1,000. The worst is that the stock price can climb without limit. If the cost keeps rising, your losses could be limitless. Short selling is thus seen as quite dangerous, since your possible losses are significantly more than your possible gains. Still, there are techniques to control these hazards. Let us now turn to some helpful techniques. Why do people short sell? One could ask why somebody would risk losing so much money on a trade. After example, anticipating a stock will go up and hoping it will go down differs greatly. People short sell for a variety of reasons, hence knowing these reasons will enable you to determine whether this approach suits you. People who short sell most usually think a stock is overpriced and will finally decline. This could be predicated on market trends, the financial situation of the company, or industry performance. Investors would thus be highly qualified for short selling if a company is suffering strong competition or declining sales, since they would expect the stock price to collapse. Short selling also helps one hedge against other assets. To counterbalance any losses, an investor who holds a stock they think might lose value in the near term may short sell a comparable stock in the same sector. Short selling thus serves as a sort of insurance. But which equities are worth shorting? How do you determine this? The fun starts at that point. How to spot a stock to short. Short selling isn't inappropriate for some equities. If you intend to short a stock, choose one that is probably going to drop. How then might one find these stocks? Examining the company's basics is one of the simplest approaches to find stocks that might be worth shorting. A corporation with bad results, too much debt, or a negative future view could have a stock price that is ready for a fall. The stock price might decline, for instance, if a company operates in a sector experiencing difficult conditions, say, a shop losing business to online stores. Technical analysis is still another approach to identify a stock to short. Here, you can search for trends by looking at stock price charts. If a stock has been continuously rising for some time and then shows indications of slowing down or reversing direction, this could be a harbinger of approaching price decline. Using technical analysis, traders sometimes search for particular trends, like a head and shoulders formation, which would suggest that a stock is about to collapse. Finally, pay close attention to market mood. Individual stocks in a sector may also suffer if the larger market is in a downturn or if bad news about a given sector surfaces. For instance, many tech stocks can suffer if negative news about the industry breaks through. Let us now discuss leverage once we know how to identify a stock too short. Leverage's role in short selling. Short selling depends much on leverage. You really do not own the stock you are selling when you short sell. Rather, you borrow it, therefore saving you from having to have the entire sum needed to purchase the shares up front. This lets you short sell more shares than you could afford from your own funds. If your margin account shows $5,000, for instance, you might borrow shares valued more than $5,000. If the stock price declines, this kind of borrowing will increase your possible gains. Still, it increases your risk, as with all leverage. Since you borrowed money to make the deal, your losses can grow rapidly if the stock price rises. With leverage then, how much might you gain or lose? Assume you borrow 100 shares on a stock valued at $50 apiece. If the stock declines to $40, you can profit $1,000 by buying back the shares for $4,000. If the stock price climbs to $60, however, you would have to pay $6,000 to buy back the shares, therefore incurring a $1,000 loss. What happens during declination? You will have trouble if you short a stock and it does not decline in price. Or worse, increases. Short selling, as we already covered, is borrowing shares, selling them, and then purchasing them again. If the price rises, you'll have to pay more to get back the shares, therefore this might swiftly result in significant loss. Short selling is therefore not for the timid among us. Making sure you're shorting the correct stocks at the correct moment calls for both a great deal of talent, research, and market understanding. How then should you decide when to call it quits? What happens when a stock doesn't drop? A short squeeze might develop occasionally when too many investors short sell the same company. This occurs as the stock price begins to rise. All the shorted investors rush to purchase it back to minimize their losses. For the short sellers, this buying frenzy might drive the stock price to increase even more, aggravating matters. You want to totally prevent a brief squeeze in all respects. Huge losses may result from it if you carelessly get yourself caught in one. Can one make money from a market downturn? Short selling can seem like an odd but interesting approach to make money when things are moving in the other direction, in a world when stock prices seem to grow continually. Short selling allows one to profit from market inefficiencies and price corrections, even if it would seem as a wager against the market. There are hazards involved, hence you have to know what you are getting into before you start. Short selling can be a useful strategy for smart investors wishing to benefit when the market declines, albeit with the correct knowledge, techniques, and risk management. Having mastered the nuances of short selling, you might be wondering, is this something you wish to do? Here the main lesson is that short selling is not a tactic to be taken lightly. It calls for thorough preparation, reliable investigation, and the capacity to manage possible losses. If you're ready to jump right in, be sure you approach it carefully and keep informed. Remember, the most crucial thing is to keep learning and developing regardless of your goals, short selling, or just knowledge of the fundamentals of market dynamics. Every choice you make about investments offers an opportunity to improve your trading. Thank you for watching.